Okay, let's get right into it. The Bank of Korea just made a big decision by doing absolutely nothing. They held interest rates steady. But what we're about to unpack is how this non event is actually a huge signal that the Korean economy is splitting right down the middle. So here's the number 2.5%. That's the key interest rate. And the Bank of Korea decided to leave it exactly where it is. Now, this rate pretty much sets the tone for everything, from your mortgage to big business loans. And for a while now, it hasn't moved an inch.
Which brings us to the big question, right? If the rate's the same, why are we even talking about this? Well, it's because while things look calm on the surface, the economic currents underneath are going in completely different directions. And this rate hold? It's our key to understanding why. To really get what's happening, we need a new way to think about the economy. So forget the idea that it's just one big single thing. Instead, picture a barbell, super heavy and strong on the ends, but pretty thin in the middle. And here is our first big clue that something strange is going on. The central bank holds rates, which usually signals they're feeling cautious. But in the same breath, they actually upgraded their forecast for economic growth. See the contradiction? How can the outlook be getting better if you're not confident enough to make a move? Wow, this chart just says it all, doesn't it? That growth isn't coming from everywhere. It is an absolute explosion in one single area. Just look at that. Semiconductor exports are up a staggering 134%. Meanwhile, pretty much everything else is just kind of plodding along. And that brings us right back to our barbell. On one end, you've got this supercharged global tech sector, humming along thanks to AI and chips. And on the other end, you've got the domestic economy, your local shops, construction, services, that's really struggling to keep up. Let's just put it side by side to make it super clear. On one side, you have this massive tech boom, with exports going through the roof and pushing up the big GDP number. But on the other side, at the exact same time, you have the domestic scene, dealing with things like delayed construction and people not spending as much. It's like two totally different economies are living in the same country. You can see how this creates a huge headache for policymakers, right? If you cut interest rates to help out the struggling domestic side, you risk pouring fuel on the fire of the tech boom and creating asset bubbles. But if you raise rates to cool things down, you could completely snuff out the little bit of recovery the domestic side has. So, what do you do? And this leads us right to the heart of the Bank of Korea's problem. They're not just managing an economy anymore. They're walking a tightrope, trying to balance growth against some really serious risks that are lurking just below the surface. The whole thing boils down to this. They're caught between two totally opposing jobs. They have to prop up the part of the economy that's weak, but at the same time, they absolutely cannot take their eyes off the financial risks that could blow up. Okay, risk number one, household debt. And this is a big one. It's been hovering around 100% of GDP, which is just massive. Think of it like a ball and chain on the economy. Any extra money people make goes to paying off loans instead of spending, which puts a major brake on domestic growth. Then you've got the currency to worry about. The Korean won can be pretty volatile. If it weakens suddenly, the price of everything the country imports, especially energy, just shoots up. That could easily bring inflation roaring back, and that's the last thing they want to deal with right now. And finally, the ghost of the housing market. They have not forgotten the recent property frenzy. The bank is terrified that if they cut rates too soon, it'll be like throwing a match on dry tinder, sparking another dangerous housing bubble that they've worked so hard to cool down. So this isn't just them sitting on their hands. It's what the analysis calls a conditional hold. The best way to think about it is a deliberate pause. They're basically standing at a crossroads, watching and waiting to see which of these forces, the tech boom or the domestic risks, is going to win out. All right, so we get the problem. It's complicated. But what does this all mean for you in the real world? Let's turn this economic puzzle into a practical playbook for how to operate in this new barbell economy. This playbook really stands on three main legs. First is selective expansion. Basically, don't just grow for the sake of growing, grow smartly where the strength is. Second, liquidity defense. Cash is your best friend right now, so protect it. And third, global diversification, making sure you're not putting all your eggs in one fragile domestic basket. This quote just nails the new reality. The old strategy of just trying to guess when the central bank is going to cut rates, that's over. The winning formula today is way more sophisticated. It's all about building an operation that's tough enough to succeed no matter what happens with interest rates.
So, what does that actually look like? Well, it means you focus on revenue from digital or global customers. That's the strong end of the barbell. You keep your overheads low so you can stay flexible. And this is huge. You focus on projects that pay you back quickly. In an economy this uncertain, getting a fast return on your investment lowers your risk and gives you cash to jump on the next opportunity. It's all about precision, not brute force.
Okay, so let's wrap this up by looking ahead. To have a really solid strategy, we need to think about what could happen next. So let's explore three possible futures for the Korean economy. So, in the best case scenario, that tech boom gets so big it starts to lift up the domestic economy along with it. The worst case, the tech cycle runs out of steam right when all those domestic risks, like debt, really start to bite. But the base case, which is the most likely path, is that this barbell economy just continues. And that demands the exact kind of resilient strategy we've been talking about. And as you can see right here, the odds are heavily stacked in favor of that base case. The most probable future is more of what we have now, an economy of two halves, where the big numbers look decent, but for many people on the ground, things still feel really shaky.
So here's the bottom line. Just hoping for a simple, widespread recovery is probably the wrong move. The real goal isn't to perfectly predict the future, it's to build your business or your investment portfolio to be resilient enough to handle this new reality. Because this barbell economy, it looks like it's here to stay.
And that leaves us with one final thought. In an economy that's strong at the extremes but fragile in the middle, the old playbook of just getting bigger and bigger doesn't really work anymore. The real question you should be asking yourself is this: are you building for resilient strength, or are you just chasing size?